US stocks are recovering and the US dollar is giving back some of its recent gains post-Powell's speech. So what should we be watching for next week? To answer this and more, I'm joined by Head of Global Content, John Kicklighter. Thank you for joining us, John.
Thank you for having me.
So, John, what are the general market conditions that we should expect to deal with next week?
So what we saw a lot from last week, I think will carry over to next week. The reason is we're in kind of a seasonal doldrum. We're in something of an open territory for a particular theme. So themes have not been very consistent. That we've swapped between 3, 4 that have been very popular over the past months. And these expectations are not being provoked by major event risk. So it's easier to default more to the traditional conditions that we expect in the summer doldrums that is a really heavy weight on volatility and market activity. And naturally that comes with a little bit of a positive lean for risk exposure. Typically in the 34th week of the year, which we just passed, we have a fairly strong performance from a benchmark like the S&P 500, which I like to use as kind of a baseline for risk appetite. And we were very much leaning against that until the Powell remarks that he gave at Jackson Hole, but it really isn't putting us on to really strong risk appetite. It really quickly returned to those doldrums, those waiting to see what picks up, or just waiting until the market returns, and then the collective can decide what it wants to lean towards. And one of the qualities that we had of last week, which was just holding out expectations, holding out conviction until the end of the week because of the Jackson Hole Powell statement, we're going to have very similar circumstances in this upcoming week, which is waiting to see what the PCE deflator, the Fed's favorite inflation indicator, says at the end of the week. So it's a lot of wait and see, which will add another additional layer of calm or reticence to the market as we try to shake off these summer doldrums for some volatility.
And what are the most potent themes that could upend the calm for the bulls or the bear?
So the themes are very unmoored. There's 3 themes that I thought were very significant over the past couple of months, and we've seen kind of a trade-off, trading of position. Obviously, it's trade wars. Have we gone back and forth into the end of that 90-day pause for the U.S. reciprocal tariffs? We have interest rate expectations, particularly for the Fed, really much center of expectation because it is kind of the largest central bank, but it also is a guide for what the rest of the central banks typically do in the developed world. And then economic activity, which is kind of a slow burn. As of up to, I think, this past week, economic activity suddenly took first place. But all 3 of these themes, if you look at measures of interest, and I like to look at tools like trends.google.com to see what the search level is of these typical themes, you can see across the board, all 3 have actually dropped off. So I don't think that there is anything that is very active at the moment. So we need something a little bit more to provoke any of these themes. And that's really what we need in terms of generating some holistic seismic movement in the broader markets. We do have a couple of flare-ups. I mean, you're going to have the deadline for the US-India 50% tariff to take place as of Wednesday. That's going to be a big one. But we have a lot of conversation and data measuring about how tariffs are impacting economic activity through consumer business sentiment, but nothing that's not really here is the definitive release that we have coming up in the week ahead. It's very piecemeal, and it adds to a narrative that the markets can readily overlook. And then, of course, we are looking at interest rate expectations, but it's until the PCE deflator adds another very key consideration to those rate expectations that we can really seize into that particular theme.
And what is the top event risk next week that could spur these themes or kick off a new focus?
So through the week, and I think it's a relatively restrained week for top-level event risk, there are a few things that I'll be looking for. I think on Monday we have the Eurozone inflation expectations from the ECB, so we get a little bit of ECB expectation, but not much. More important, I think, are the U.S. figures of housing sales, as well as the Chicago Fed's National Activity Index. A broad perspective, very important themes, very important for the U.S., but not really market moving on the holistic consideration. But we get into something a little bit more on Tuesday. In the Asia session, we have Hong Kong trade, which I think is important as a proxy for China. But I'll be watching the U.S. docket. You have U.S. durable goods, you have U.S. housing prices, but I'm really going to be watching that conference board figure for consumer confidence. After the U of M figure showed some serious concerns about inflation and softening confidence of the economy, that is a narrative that the White House is not going to be pleased with. So we want to see if the conference board reinforces it or perhaps conflicts with it and gives something of a better narrative for the White House to work with. If not, they're going to intensify the pressure, I think, on Jerome Powell and the Fed and other areas where they're trying to get some quick growth. Wednesday, obviously, I said in the U.S.-India 50% tariff rate goes into effect. That is meaningful. It's expected. The discussion points around it have not been good from either side. It looks like it might go forward. So we'll have to see what that actually does in terms of market activity. But aside from that, Chinese industrial production, Mexico trade, and after hours, Nvidia. Nvidia earnings are going to be, the end point of the season's earnings for most intents and purposes. And it is a disproportionately large company. And you can go into the AI considerations of it, the particular performance of that particular company. I'm watching it as a sentiment guide for the capital markets. So if it does really, really well, which the expectations are, then it will defy those more traditional growth concerns and say that innovation via AI and the market cap concentration can keep the markets propped up. Thursday, Eurozone confidence, U.S. corporate profits in the Asia session into Thursday evening, Friday morning. Japanese jobless rates, industrial production, retail sales. So Japan's going to give a good overview. And then through Friday, India and Canadian GDP, important, obviously, with the context of trade. U.S. trade is going to be on pace, but really you're going to be waiting, and a lot of talk will build up into the PCE deflator. Usually the market is preferred inflation figure for the United States is CPI, but given the greater intensity of the conversation of inflation risk versus the labor market risks, which the FOMC meeting minutes this past week suggested that they are leaning more towards concern about the inflation risks, there's going to be intense scrutiny on additional data that is surrounding inflation. So this may become a more popular indicator than it typically is in the open markets.
Excellent. Well, thank you very much for your insights as always, John.
Thank you.
For more videos like this, please do like and subscribe.